Hello and welcome to the Investing on the Go podcast brought to you by Fund Calibre. I'm Ryan Lightfoot-Brown and today we're joined by Richard Hallett, the elite rated manager of the Marlborough UK Multi-Cap Growth Fund. Richard, thank you very much for joining us.
Pleasure.
Can you tell us what your view of the UK or even the global economy is at the moment?
Yes, of course. The UK economy as we see it at the moment is growing at a fairly tepid rate of about 1 to 1.2%, depending on who you speak to. But that is on a slowing trajectory. Really, this is due to the ongoing effects of the Brexit uncertainties and the effects that's having on entrepreneurs and business leaders and the slowdown in decision making in the business environments. It's also having an effect on consumer spending habits as well. And we see all these areas sort of really being affected, particularly in the car industry, in the construction sectors, hospitality, and in the retail space as well. But having said all that, this 1.1% growth we see as being particularly resilient given the geopolitical sort of headwinds that the UK economy is enduring. But without forecasting the Brexit outcome, we see a continuation of that sort of trend. Conversely, on the global side of things, growth is about 3%, again on a slowing level, but more impacted by the US versus China trade negotiations, which have been upping in ante over the last few months. This is an ongoing process and it remains volatile and uncertain, but we view this sort of level of growth as quite attractive given the very low levels of interest rates globally, and indeed the fact that interest rates are likely to be lowered again later this year given very recent comments from the European and Federal Reserves or central bankers.
And how does that view impact your investment decisions?
Well, I think the first point on this is that we take the view that forecasting economic and political scenarios is incredibly difficult to do on any sort of reliable or consistent basis. And this really sort of plays into the fact that and why we prefer to select companies which have an ability at least to, or potential to grow through the business cycle with a sort of a really sustainable growth irrespective of the economic outlook. They can do this by being a leading position in sectors which are really benefiting from powerful long-term structural growth trends, or what we call secular growth. And these trends we see as being particularly global in nature. And this is why the fund is positioned in companies which are quite global, have global franchises. And this enables the fund to benefit from, as we previously discussed, a sort of stronger global growth backdrop and protects it from perhaps a more tepid UK situation.
And what's the stock in your portfolio that excites you the most and why?
Okay, Craneware is one of our largest holdings in the fund. And it's a software business delivering what they call value-based solutions, specifically to the US healthcare market. And what excites us the most is their investment that they've been deploying in the last few years into a completely new range of cloud-based software products, providing enhanced data analytics and pricing solutions to their existing customer base and indeed hopefully new ones. And this new Trisus product range have typically annual licenses of between 1.5 to 5 times the value of their existing average product prices. And very importantly, we think that the cross-sell opportunity into particularly their existing customer base is quite realistic. So any sort of pull-through in demand in this new category of products we see as being quite a significant contributor to their bottom line profits.
And you tend to avoid oil companies and utility companies. Why is that?
Well, we see oil and other commodities, for that matter, as being volatile commodities, which are driven by very hard to predict variables such as demand and supply, but also geopolitics and economic factors also tend to be quite material factors. So it's a very complex situation in which to analyse, and leads us on, lenses to the view of why we prefer businesses with a more stable earnings structure and a sustainable ability to grow their profits for the longer term. Utility companies are slightly different, but the drawback there, as we see it, is that they're vastly sort of regulated entities with controls on pricing, but also increasing scrutiny on the amount they can spend on things like capital expenditure. This acts as a barrier, perhaps, to maximising shareholder returns, and also adds risk to their future levels of profitability. And finally, our final factor is that a lot of the utility companies are highly leveraged and got lots of debt on their balance sheet, which we think limits their headroom in the event of a slowdown or shock to their business model.
You touched on that you look for companies with a sustainable competitive advantage and that can grow throughout the market cycle, but I see Tesco's is in your top 10. Is this company not at risk from the likes of Aldi and Lidl?
Yeah, that's a good point. Interesting. But as part of our investment strategy, alongside our core holdings, we do retain the ability to have up to 10% of the portfolio in what we see as shorter-term tactical positions, taking advantage of attractive opportunities as and when they arise. And Tesco really fits within this category. It's going through a period of strategic change where the management are looking to double operating margins over a few years, which we think is credible. Another point, I think, is that Tesco's, as we see it, is a very powerful brand, and it's also the largest purchaser in its market, particularly as it's entered into a JV with Carrefour quite recently. And it's these two factors which we think give it an edge in holding off competition in the medium term. But I agree with your thought about this competitive dynamic and loss of share, and it's with that point in mind that it's probably unlikely to be a holding for the longer term.
And can you tell us a bit more about another company in your portfolio, perhaps London Stock Exchange, which our listeners will be well aware of?
Yeah, that's another company which is one of our larger holdings and has been very successful for a number of years. The LSE has completely re-engineered its business model over the last 5 to 10 years, away from the more volume-driven capital markets activities, and really positioned itself as a leader in the information services business, and also in the clearinghouse for over-the-counter derivatives. And this new model that the LSE is focusing on really positions itself in the strongest growth trends within finance today, which are the growth in ETFs, OTC clearing, risk management, and also quant investing. And another factor, I think, is that whilst the LSE itself has been acquisitive over the last few years, and it's recently picked up a stake in Euroclear, the global sector is indeed consolidating, and it's been well rumoured that the London Stock Exchange itself could be a target at some stage in the future.
And last time we met, you mentioned e-commerce was a theme in the fund. Is this still the case?
Yes, it is. We see e-commerce and the move away from bricks and mortar to e-commerce spending has been is a very strong and powerful trend that's going to continue for many years. And our holding in Boohoo, which is a leading young fashion e-commerce company, is really benefiting from that trend, and it had very powerful results a week ago. I should also mention that e-commerce growth is really driving the growth in digital payments globally, and our holding in WorldPay has been doing very well over the last few years. There's lots of M&A and consolidation activity in that market. WorldPay merged with an American company called Vantiv last year, and the combined group has been acquired by Fidelity National Information Services in the last few months. So this really does demonstrate the growth in this sector.
Well, Richard, thank you very much. That's been really very interesting. And thank you very much for listening. I've been Ryan Lightfoot-Brown, and if you'd like to listen to more of our Investing on the Go podcast, please subscribe to Fund Calibre. Please remember, we've been discussing individual stocks to bring investing to life for you. It is not a recommendation to buy or sell. The fund may or may not be holding these stocks at time of your listening.